So we can start. This is the first class of advanced taxation. I want us to start with cross-border issues. Cross-border issues. So for advanced taxation, you only have one class per week, but there are sometimes we'll be adjusting, we'll be having two classes. The reason is because that taxation is not that wide. It's one of the simplest. And then for this class, I always share the notes in advance. You print, we discuss so that we can do as many illustrations as possible. So, but for the first class, I want us, for this topic, I do a dictation, you write. But from the other classes, I'll be sharing the notes in advance. So make sure you have the past paper. I had already shared with you the past paper. You have the past paper, the handout, and the notes. I'll be sharing the notes topically. Per topic, the one we'll be discussing. Good. So now, right? The topic is cross-border issues. Cross-border issues. Then I want us to start under that subheading. We have what you call double tax. Yeah, double tax taxation agreement. Cross-border, we start with double taxation agreement. Double taxation agreement. Double taxation agreement. DTA. We like to see that. DTA is an agreement. DTA is an agreement between Kenya and other countries. It's an agreement between Kenya and other countries seeking to address the implications, seeking to address the implication and avoidance, implication and avoidance of double taxation. The implication and avoidance of double taxation. Full stop. Then right, you see that? It's provided for by section 1, section 41, provided for by section 41 and 42, 41 and 42 of the Income Tax Act, of the Income Tax Act, of the Income Tax Act. Income Tax Act, like that. Then right, you see that? Kenyan residents are taxed on worldwide, employment income. Worldwide employment income. Full stop. Then right, you see that? Non-residents are taxed only on incomes, only on incomes which are deemed to be on incomes which are deemed to have accrued in Kenya, accrued in Kenya. What does that mean? saying that a Kenyan resident will be taxed on worldwide employment income. What about non-resident? If you're not a Kenyan, only the income which was accrued in Kenya. What does it mean? Now, the implication of double tax agreement, this is what happened. Assuming that during a particular year, for example, financial year 2022, you are in Canada for 6 months, and then you came back to Kenya, you worked for the other 6 months. In Canada, you had an equivalent of employment income of 4 million. And then in Kenya, you earned maybe 3 million. So that means during that financial year, you earned a total of how much? 7 million. Now, when you'll be filing your annual returns, how much will be assessed, or will you pay tax based on which amount? Is it 4? Is it 3? Is it 7? Now, we are talking about you Kenyans. We have other students. We're talking about you Kenyan students. No, I mean Kenyan citizens. Which amount will be assessed for tax purposes? 7. Good. This amount. But remember, also in Canada, the amount you earned in Canada, because you're residing in Canada, there are some taxes you are paying on employment income. So that means on this 4 million, you paid some taxes in Canada. Then in Kenya, if you assess the entire 7 million, that means you'll be paying tax twice on the same amount. So now, to avoid this, that's why you have the double tax agreement, to avoid the double taxation. Now, as a Kenyan resident, the amount to be assessed will be 7 million. What about in case of an unresident? These are Canadian citizens. Relocated to Kenya, and during that financial year, it was only in Kenya for 6 months, of which he earned an equivalent of 3 million. How much will be assessed? Only 3 million. Good. Then, right? Let me see that. Now let's look at objectives of DTA. Objectives of DTA. Objectives of DTA. So what are some of the objectives of having a double tax agreement? Objectives of DTA. Number one, you see that? To facilitate state of technology, in commerce, without making the investor overburdened, without making the investor overburdened with tax liability. Another one, to facilitate exchange, the exchange of technical personnel, without overburdening the person, with heavy taxes, Another one, to make domestic registration, comparable, to make domestic registration comparable with other countries, which Kenya has a DTA with, Good. Now let's look at conditions, subheading. Condition under which tax credit, condition under which tax credit is granted, condition under which the tax credit is granted. Now, normally this is what happens. If a country, that means Kenya and another other country, for example, in Canada, there was a DTA, double tax agreement. That means, for example, if you assess this amount of 7 million, and then you realize that you're supposed to pay a tax of 2 million, this is a tax based on the assessed income of 7 million. But remember, in Canada, you had paid some tax. So that means the amount of tax you had already paid in the other country will be credited, will reduce your tax liability. Now that's what we call the tax credit, but there are some conditions. So for example, let's assume that in Canada, you had paid an amount of 800. So that means you only pay an amount of 1.2. But what are some of the conditions for you to be granted this tax credit? Number one of the conditions, there must be a DTA. There must be a DTA between Kenya and the other country. There must be a DTA. There must be a DTA between Kenya. There must be a DTA between Kenya and the other country. That's one of the conditions. Number two, confirmation that the tax was actually paid. Confirmation that the tax was actually paid in the other country. Confirmation that the tax was actually paid in the other country, which Kenya has a DTA with, which Kenya has a DTA with, which Kenya has a DTA with. I'll come to discuss later. How do you confirm that you had already paid the tax? You know, the taxman, number one, will not lie with your information, like telling them, when I was in Canada, I paid 800. So how do they confirm? That is what we call, whenever there is a DTA, there must be what we call the tax information exchange, TIA. We'll come to discuss this later. So now what happens? The revenue authority in your country will contact directly the tax authority of the other country, because there is what we call the tax information exchange agreement for them to confirm. Another condition. The tax deducted in the other country, is not more than the tax deducted in that country is not more than the tax that would have, is not more than the tax that would have been paid, not more than the tax that would have been paid in Kenya, the tax that would have been paid in Kenya on the same income, Yeah, what does that mean? Can you go through that point again? For you to understand. Have you understood? That the tax paid in the other country should not be more than the tax that would have been paid in Kenya for the same income. What does it mean? Assume that if you assess this income, and in Canada, you paid 800,000. Then you assess, now using the Kenya tax rate, using the Kenya graduated scale rate. But now, in Kenya, the amount you are supposed to pay now, using the Kenyan graduated scale rate, it's only 600. For the income you earned in the foreign country, if you assess on Kenyan amount, you are supposed to pay 600. But you had already paid 800 in the other country. Now, how much will be the double tax relief? or the credit? Is it 600 or 800? It's 600. We are saying that the tax paid in the other country should not be more than the tax that would have been paid in Kenya on the same amount. You say in this case, this is what you are saying that. If you assess using the Kenyan tax here, this is what you are supposed to pay. But you tell them, no, don't give me a credit. I had already paid 800. No, they'll tell you no. The maximum we can grant is how much? 600. That's the relief you can get. Another point, another point, another point, another condition. The time limit for making tax credit claim, the time limit for making tax credit claim must be within 6 years, must be within 6 years since the date the tax liability was made. Since the date the tax liability was made. The tax liability was made. Yeah, go through that point again before I explain. Read it again. Yeah, what do you understand? Now, this is what it means. Assuming now you're not tax literate, and when filing your tax, you didn't even engage an expert, or in case you engage an expert, you didn't give all the clear information. That means in Canada, you declare 4 million, Kenya, you declare 3 million. So that means the assessable income is 7 million. Then you assess 7 million and see that you are supposed to pay a tax of 2 million. Then innocently, you pay the entire 2 million. Assuming you have no knowledge that you are supposed to claim a relief. Then after 2 or 3 years, you meet your CPA friend, CPA, and then informs you that, no, you are supposed to make a claim for the double tax relief. We have a double tax agreement with Canada. And then we realize that I paid 2 million, I was supposed to make some claim. If you are to make that claim, the duration should be within 6 years. Yeah, that means if you realize this after 8 years, you cannot make any claim. But if you realize within 6 years, you can make the claim. Good. Now let's look at, those are the some of the conditions in which you can claim the tax credit. Let's look at something else. Types of subheading, types of double tax relief. Types of double tax relief, stroke, types of double tax relief, stroke, methods of determining, tax relief. Methods of determining the tax relief. So don't write. First of all, let me explain. We have 2 methods we can use. Number 1 is known as the exemption method. And then number 2, we have the credit method. Those are the 2 methods used to determine the tax relief. Now, the first one, exemption method. That means, in this case, the assessable income is 7 million. What happens in this case? The amount earned in foreign country, which Kenya has a DTA with, will be exempted when assessing the taxable amount. This means of the 400 and 300, the total is 700. If you choose the exemption method, the income earned in the foreign country will not be considered. So that means you will not consider 4 million. Now you'll only assess the amount earned in Kenya. That's 3 million. That's what we call the exemption. But now, section 41 and 42, they discourage the recommendation of using that method. Why? They discourage. Because, okay, I'll come to explain later. Then we have credit method. Credit is what I have explained here. In this case, they assess the entire amount. That's the full amount. And then they give you a tax credit for what you had already paid in the other country. So exemption, the amount earned in the foreign country will not be assessed. Credit method, you assess the total amount, but in this case, you'll only be granted double tax relief for what you already paid in the other country. And this is the method applicable by KRA, credit method. So now let's write number one. Number one, we're looking at the methods of determining tax relief. Number one is exemption method. Exemption method. Exemption method. Right, we say that? Under this method, comma, under this method, comma, income earned in the foreign country, 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 are only subjected to tax, are only subjected to tax, are only subjected to tax in that country, are only subjected to tax in that country, and therefore shall not be considered, and therefore shall not be considered, and therefore shall not be considered in home country, and therefore shall not be considered in home country, and therefore shall not be considered in home country. Yeah, that means to be exempted. Number two, yeah, but you'll see that KRA does not recommend the use of that method. Number two, credit method, credit method. Right, you see that? Under this method, comma, under this method, comma, the tax paid in the foreign country, the tax paid in the foreign country, tax paid in the foreign country, tax paid in the foreign country, we reduce the tax liability, we'll reduce the tax liability, we reduce the tax liability, we reduce the tax liability payable in Kenya, we reduce the tax liability payable in Kenya. Can you write this that? The credit is only granted. The credit is only granted only if the tax is only granted only if the tax paid in the foreign country, only if the tax paid in the foreign country, the tax paid in the foreign country is lower than the tax paid in the foreign country is lower than tax that would have been paid in Kenya, tax that would have been paid, tax that would have been paid in Kenya on the same income, on the same income, on the same income. Good. Those are the two methods of determining the double tax relief. Now let's look at benefits of DTA, benefits of DTA. Yeah, why should a country or why should Kenya sign a DTA with another country? Why should we sign? Number one, it enhances exchange of qualified experts. It enhances the exchange of qualified experts. Yeah, that's one of the encouraged, because now, for example, assuming that you decide to go, for example, to work, which country would you like to work? Canada. This Canada. What about the woman rep? UK, yeah? Woman rep too. Which country? If you're to give an opportunity to go and work for 2 years, you better stay in Kenya. Ruto. Sorry? Mexico, eh? What about you? Australia? China. China, UK. We come to this side. Australia, Angola. Yeah, there are some people who love Africa. Yeah. Kingston. How many Jamaica? UAE, UAE. Oh, Mary, USA. Yeah. So if you're given, yeah. But then which is the best country for Africans to live? Where you'll feel that at least you are comfortable. To be honest, US, you cannot never be comfortable. You regret being born black, let me tell you the truth. Yeah. Even ask your friends who work there. They're only happy when they come here or when they meet their other black people. But we have some countries which are neutral. Also, Britain is not that good. Also, China. Actually, China and India. UAE, it's okay. You know, UAE, it's only 20% are the locals. They're 80% are from other nations. Australia is okay. No, Angola, they not even recognize that you're from Kenya. For example, in Kenya, okay, if you walk in the street in Kenya, will you know these around this? It's very difficult. The only people you know somehow are Nigerians, Sudanese. Yes, those are. But from South Africa, it's only mostly from Sudan. Okay, Nigeria is by the way how they talk. In case they are quite, and their dress code, you can tell this one is from Nigeria. Anyway, now assuming that you go to work in that country, where you are earning, for example, let's assume you are earning 600,000 Kenyan shillings per month. Then you are taxed in that country. And then when you come back to Kenya, the KRI, the same income, they tax at the same rate of 30%. How will you feel? You know, you ask yourself, when have I been working for the government? Are you getting? But to minimize that problem, so what happened? They signed a DTA. Mostly when you have a lot of Kenyan working, our government always makes sure they have that agreement. So that when you're taxing that income, what is left, that's yours. But imagine you are being taxed, you take your money to the bank, then when you come back to your country, the same amount will be taxed again. That means the same income has been taxed twice. Yeah. So that was one of the benefits. Number two, you have said that to enhance the exchange of qualified experts. Number two, increase labor mobility. Increase labor mobility between countries. Increase labor mobility between countries. Increase labor mobility between countries. You know what's labor mobility? Movement. Yeah, another one. Transfer of technology. Transfer of technology from one country to another. Transfer of technology from one country to another. From one country to another. Another one. Increased trade. Increased trade. Increased trade between two countries. Increased trade between two countries. Increased trade between two countries. It does not only apply to the employment income, also sometimes in goods. That's why, for example, if we export good, if we export, do we charge some tax? Now, for example, VAT. If you import, you'll pay VAT, right? What about the exports? The exports are zero rated. Why? Because to the other country at the point of entry, they will be taxed. Are you getting? So assuming now you are exporting something you are taxed in Kenya, then to the other country, they also taxed. So what will happen? The price will shoot, right? Yeah, so that's another thing. But in case if you have a DTA, that means at the point of origin will not be taxed Good. So, and that one will increase the trade between the two countries. Another one, promotion of investment, promotion of investment, promotion of investment due to reduced tax liability, promotion of investment due to reduced tax liability, due to reduced tax liability. I've said that promotion of investments due to reduction in tax liability. Tax liability. Good. So now let's look at procedure, subheading. Procedure of computing, procedure of computing, procedure of computing double tax relief, procedure of computing double tax relief, procedure of computing double tax relief. How to determine the double tax relief? Number one, determine the taxable income earned in Kenya. Determine the taxable income earned in Kenya. Determine the taxable income earned in Kenya. Number two, determine the taxable income. Determine taxable income. Determine the taxable income earned in the foreign country. Determine the taxable income earned in the foreign country. And in the foreign country. Step number three. Aggregate the total income. Aggregate. That means you sum. Aggregate the total income. Aggregate the total income in bracket from Kenya and foreign country. 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 Number four, compute the total tax liability. Compute the total tax liability. Compute the total tax liability. Compute the total tax liability on total income. On total income. Compute the total tax liability on total income. Step number five, determine the tax liability. Determine the tax liability on income earned in Kenya. Determine the tax liability on income earned in Kenya. Determine the tax liability of income earned in Kenya. Lastly, the difference between, that's number 6. The difference between number 4 and number 5. The difference between number 4 and number 5 will be the tax, liability, will be the tax liability on foreign income, will be the tax liability on foreign income, will be the tax liability, on foreign income. Yeah, those are the steps followed. And it's very simple. And this one actually is a very common question. And you have seen that. How to determine the double tax relief? Step number 1, determine the income earned in Kenya, the income earned in the foreign country. Step number 3, you just add the two to get the total income for the year, right? Once you get the total income, determine the total tax liability on that total income. Once you determine the tax liability, then compute tax liability on income earned in Kenya alone. So the difference between now the total tax liability on the total income and the tax liability on income earned in Kenya now will be deemed to be the tax on the foreign income. Then from there, so for example, now let's assume that was step number 4. Step number 4, you have to determine the tax liability on the total income. Assuming the total tax, the total tax will be 2 million. That's on the total income. Then you compute the tax, on income earned in Kenya. If you compute the tax you're supposed to pay on the income earned in Kenya, and then, for example, you get was 1.2. So how much the difference? The difference will be 8. Now, this 8 will be deemed to be the tax on income earned in the foreign country. Then how do you get a relief? For you to get a relief, you compare this tax against how much had you paid in that country. Right, together? How much had you paid in that country? If, for example, in the other country, you had paid an amount of 600, so to get the double tax relief, whenever this what happens for tax purposes, whenever you are getting any benefit from KRA, they always take the lower off. Right, together? If they are assessing you and there is something you compare, they always take the higher off. Right, together? The higher off. That's what happens. But in case you want a benefit from them, they're lower off. From you, for example, if you are to have the house allowances, how do you compute the house allowances? 15% of the total income, or the actual amount paid times the higher off. But if you have to get any deductible income from them, they take the lower off. So what will happen? The double tax relief will be the lower off. So in this case, the maximum you can claim as a relief will be 600. Good. So take out your past paper, you do an illustration. I had shared with you the past paper by WhatsApp, all the groups. And then I want us to take some few minutes, a break of 5 minutes. So we can proceed. Let's do some illustrations. June 2011, question 5B. June 2011, question 5B. June 2011, question 5B. Then I had shared two past paper for the online student. Two past paper. One is from 2015 to date. Then we have from 2014 going backward to 2007. It's there. June is there. It's not there. June 2011. But for me, I can see it from my past paper. The second last page. Okay, let me see. Let me see. June 2011, question 5. It's there, yes, it's there. The second last page, eh? 2015. I think what they have done now. I think you'll take it back to her. You'll have to arrange for you. When did you make this copy? Just now. You don't have the question, let's just dictate it. It's just a small question. Eh? You don't have that one, then we dictate. Eh? It's just like a small question. We right to see that? Hodari Nkari, but you can use the soft copies. You have the soft copy. Yes. You have the soft copy in your notes. Eh? Just use mine. Part B, June 2011, question 5B. Now, we are told that Hodari Nkari is a resident of Kenya, and during the year ended that 1st December 2010, he received the following income. So from Kenya, 720,000, from Zambia for 540,000 net of tax. Assume that Kenya has a double tax agreement with Zambia required. The double tax relief due to Hodari Nkari for the year ended that 1st of December 2010. Now, what are some of the process or steps in determining the double tax relief? So that number one, you take the income earned in the home country, that's Kenya. So income earned, don't write in Kenya. Then step number two, you determine the amount of income earned in the foreign country. In this case, we have Zambia. Then step number three, you get the total, you aggregate the two. That's how you get the total income. So the income earned from Kenya was 720,000. Then income earned from Zambia, 540, net of tax of 78. We don't assess net. We always assess the gross income, right? So it was an amount of 540 plus you add back the tax paid of 78 and you get an amount of 618. That means during the year it had earned a total of how much? Is it 1338? Yes. 1338. That's the total income earned during the year. Fourth step. Now you determine the total tax liability on the total income. So we determine the tax liability on total income. How do you determine the tax liability? We use what we call the graduated scale rate of tax, the one you use to file your, to determine your payee. Yeah, so I want you to use the most recent past paper, the most recent 2022, one for 2022, because the rates keep on changing. The rates keep on changing. Use this. The first page used for 2020, the first page you are given that graduated scale rate of tax. Are we there? Yeah, so we have the monthly tax pay and then we have the annual tax pay. The first bracket we have now, in this case, we are accessing the annual income. The first range we have is 1 to 288. Any income between 0 to 288, they pay at a rate of how much? 10%. Then between 288 to 388, that's a difference of how much? 100,000. That means for the next 100,000, you'll be subjected at the rate of 25%. We are using the most recent, either for April, August, or December, but use for August or December. Then anything in excess of 388 will be subjected at the rate of 30%. We use that. It's 10% for the first 288,000 plus 25% for the next 100,000, because the range is between 288 to 388. The difference is 100,000. It's at the rate of 25%. Then 30% of anything in excess of 388. So we determine the amount of excess. So you'll take 1338, you minus 388, you determine the excess, then you multiply by 30%. How much is that? This one is, first of all, let's start with this. This is 25,000, right? This is 285,000. Then you add 25,000. Then you add 28,800. So how much would be the total tax liability? Sorry? 338? 800. That was step number 4. You determine the tax liability on the total income. Then the other step, I hope you are not writing. You determine the tax liability. I'll give you time to copy on income earned in Kenya. And now we assess Kenyan income separately. Use the same process. How much was earned in Kenya? 720. So we use the same graduated scale rate of tax. 10% for the first 288,000. 25% for the next 100,000, and then 30% of anything in excess of 388. So the total amount earned in Kenya was 720. You deduct 388 to determine the excess amount, and then you subject at the rate of 30%. Then once you get that, you add 25,000, then you add 28,800. How much is that? $153,400. So step number 4, you say that you determine the tax liability on the total income. The other step, you determine the tax liability on income and in Kenya. Then the last step was the difference between the two will be deemed to be the tax on the foreign income. So the difference between the two will be deemed to be tax liability on income earned in Zambia. How much is that? Sorry? 185,400, right? Yeah. So the tax on the foreign income will be 185,400. But how much had you paid in Zambia as tax? Good. Actual tax paid in Zambia, you had paid an amount of 78. Now, what was the question? Let's go to the required. The question was, the double tax relief due to ordinary incurring for the year ended that 1st December 20. Double tax relief. How much will be the relief? Now, to get the double tax relief, we see that you'll only be given the row of. So the row of the actual, the actual and the total tax liability. So how much the double tax relief? 70. So that means of this 185, you had already paid 70. This is the relief you get. So that means the balance you have to pay back to KRA. Good. So now you can copy. Yes, the balance, but in this case, they just want the relief. So the balance is what now you pay to the KRA. Yes. In short, it will be deemed as unpaid tax on the income earned in the foreign country. Yes. Hello. Evening to you. Which class? Oh, intermediate. Oh, FM, eh? Did you? Oh, okay, sawa. Eh? Okay, sawa. Okay, hello. Yes, walinga tu ya yule wako ukwira kuna mwenye alikuwa amejaribu kunipigia ingio class FM. Mimi sasa amesaidiwa na Trifena, lakini najua ni student wako lugha kiago kama mimi. Nitadomira sababu Trifena voka. Sasa hiyo itakuwa ishaandikwa. Lakini unajua pale urudi ushaandika edition nini? Na Let's do another illustration. December 2013. Sorry, June 2013, question 2A. June 2013, question 2A. June 2013, question 2A. June 2013, question 2A. And so you're told that Mr. Alex Magambo works partially in Kenya and partially in Canada. His family is based in Kenya. And during the year ended that 1st December 2012, Mr. Magambo earned an equivalent of 3.6 from his employment in Canada. So income earned in Canada. He earned an equivalent of 3.6 million Kenyan shillings. Then we determine the income earned in Kenya. Then we are told that he paid an equivalent of 480 as tax on the income. So the actual amount of tax paid was an amount of 480, but note that, you see, for example, the other question we did, the amount of 540, you are told that net of tax of 78. That's why you had to add back 78. But in this case, we are not told that 3.6 was net. So that means 3.6 was the gross, of which on that amount, he paid an equivalent of 480,000. So don't add back. You only add back whenever they have specified that the amount was net. He also earned 1.8 as consultancy fee in Kenya, in addition to employment income of 1.2. Pay was 400. His employer in Kenya provided his family with accommodation. The monthly rent on accommodation was 60,000 per month, which was paid by the employer. Now remember, house allowance, it's part of the taxable employment benefit. So therefore, they'll be assessed for tax purposes. So how much is the income earned in Kenya? Number one, there was consultancy fee, right? He earned an amount of 1.8 as consultancy fee, in addition to his employment income. So there was employment income. In addition to his employment income of 1.2. So there was employment income of 1.2. Then you told that his family in Kenya provided his employer in Kenya provided his family with accommodation. So that means the employer who is paying. So that means to Mr. Alex, to him is a house benefit. It's paid by the employer. The monthly rent on accommodation was 60,000 per month. So how much therefore will be the annual pay? So we have accommodation. Accommodation is the taxable employment income. So it's 60 times 12, it will be an amount of 720. So how much was the total employment income? 1920. So how much was the total income earned in Kenya? That's 720. Then step number 3 was you aggregate to get the total. So therefore, give me the total income earned during the year. You get 70? 73. That was step number 3. What about step number 4? Step number 4, determine the tax liability on the total income. So we determine the tax liability on total income. Using the graduated scale rate of tax, 10% for the first 288,000, 25% for the next 100,000 and then 30% of anything in excess of 388. So we are assessing the total income, which is 7320. Then you deduct 388 to determine the excess amount. What do you get? Sorry? 400. Good. Then the other step was to determine the tax liability on income earned in Kenya. Use the same graduated scale rate. 10% for the first 288,000, 25% for the next 100,000, and 30% anything in excess of 388. The income earned in Kenya, the total was that 720. You deduct 388 to determine the excess amount. Then you subject it at the rate of 30%. Sorry? 1053,400. Then the other step, the difference between the total tax liability and the tax on the income earned in Kenya will be deemed to be the tax on the foreign income. So how much will be the tax on foreign income? An amount of 1080,000. To determine the double tax rate, you compare this 1080 against the actual tax paid in Canada. Actual tax paid. Remember, in Canada, he had earned an equivalent of 3.6. Paid deducted was how much? 480. On this income, he had paid an amount of 480. Now you need to claim a relief. So the double tax relief, see that is the lower of. The maximum you can claim is how much? 480. Good. Now let's go to the required. What was the question? Required. Tax liability for Mr. Alex Magambo for the year ended that 1st December 20. They are not asking about the double tax relief. They want the tax liability. Tax liability. How to determine the tax liability? Now, to determine the tax liability, we take gross total tax liability. Now, based on the total income earned during the year, 7320, the total tax liability was an amount of 21,33,400. Are you together? Based on the total income, this was the tax liability. Then from the income he had earned in Kenya, he had already paid some pay. You deduct what he has already paid, pay. Yeah, of this, an amount of employment income of 1.2. How much was the pay deducted? He had paid 400. Then, for the income earned in the foreign country, you claim a relief. You also deduct that double tax relief, the lower of, which is an amount of 480. And then you claim the personal relief. Now, for the personal relief, use the graduated scale rate of tax. You are given the personal relief. 28,800, that's per annum. But you have the graduated scale rate, you have the relief, the personal relief. For per year, it's an amount of 28,800. Therefore, how much will be your tax liability? How much are you supposed now to pay to KRA? 1224,600. Good. You can copy. We do another one. November 2016. November 2016. Question 4B. November 2016, question 4B. Sasa umeanza na klasi ya kwanza eh? Take it positively. Utavuka tu. Sasa unaona the good thing is mimi kama umeanza na klasi ya kwanza hata kama utapita. Now you have my blessing. Siko nimekubariki. Sasa nimekubariki. So we are told that question 4B. I was taking a small break so that you can open the question. November 2016, question 4B. It's for Mr. Silvanus Jirani. So we are told that Mr. Silvanus Jirani was a resident of Kenya in the year of income 2015. During part of the year, he was in the United Kingdom and earned income amounting to 43,500 pounds. Taxes paid in UK income amounted to 8,700 pounds. His employment income from Kenya was 950,000 and paid deducted was 184,800. Further, he had provided consultancy services at a fee of 190,000 net of withholding tax. Actually, professional services attract a withholding tax of 5%. So he received 190. That was net of withholding tax. Other income comprised the following. There was rental income of 400,000 after deducting cost of furniture, that's 6,000, estate agent fees before rating 48, and caretaker wages of 8,000 per month. Number 2, patent rights, where he received a net royalty income of 95. Also royalty attracted withholding tax of 5%. Expenses relating to patent or registration of the patent at 8,900 and operating expenses of 18,000. Assume the applicable exchange rate was 100 Kenyan shillings per pound or to pound. Kenya has signed a double taxation agreement with UK. Required. Double tax relief, if any, due to Mr. Silvanus Jirani for the year of income 2015. Also the tax payable or refundable by Mr. Jirani for the year of income 2015. So what are the steps in determining the double tax relief? Income earned in Kenya, income earned in the foreign country, get the total, tax liability on total income, tax liability on income earned in Kenya, then the difference between the two is the tax on foreign income. So he was working in UK. How much did he earn in UK? he earned an equivalent of 43,500 pounds. Remember, he's being assessed in Kenya, so you have to convert them into Kenyan shilling. What was the applicable exchange rate? 100. 1 pound is equivalent to 100. So you multiply by 100, and that will be equivalent to 4.35, right? Then you determine the income earned in Kenya. Income earned in Kenya. And for the income earned in Kenya, there was employment income. And we have been told that his employment income in Kenya was 950,000. So number one, there was employment income. What's an amount of 950? Further, he had provided consultancy services at a fee of 190 net of withholding tax. Consultancy fee. He received an amount of 190,000, but was net of withholding tax. We say that we usually do assess the gross income. We have said that withholding tax is at the rate of 5%. So you divide by 0.95, or you can argue like this, that 190 is net. They are already deducted 5%. So this one is equivalent to 95 pounds. What about 100%? That's why I'm dividing by 0.95. How much was the gross? 200. Yeah, the gross income was 200. Then you're told that other income comprised the following. Number one, there was rental income. Rental income of 400,000 after deducting. So we have rental income. Rental income, he earned an amount of 400, but this is net. Why? Because we are told that rental income of 400 after deducting cost of furniture. Now, furniture is an asset. We'll come to discuss this. Now, asset is not an expense. They'll qualify for what we call wear and tear. Wear and tear. But in this case, he had already deducted the cost of furniture. So you add it back as what we call disallowable expense. Don't cram that. We'll do that in our business income. So you add back disallowable expenses, such as the cost of furniture. He was not supposed to deduct this because this one is an asset. The capital expenditure is not an operating expense. An amount of 36, you add it back. Also, there was estate agent fees before rating. Before rating, any expense incurred prior to the asset has started generating income, they are known as preliminary expenses, which are disallowable expenses. So, any expense we incur prior to, they are known as preliminary expenses, which are disallowable. So you add it back. So you're adding back disallowable. So estate agent fee. It was incurred before rating, an amount of 48. And caretaker wages of 8,000 per month. Caretaker wages, that's okay. That's an operating expense. So you add that, but remember you had already added back the cost of furniture. Furniture is a capital expenditure. So you add it back, you claim wear and tear. Wear and tear, good. So we deduct wear and tear. For furniture, it's at the rate of 10% of 36. Don't cram that. We'll come back to that. Another topic. So you'll claim an amount of 36. So give me now the taxable rental income. Taxable rental income. We also come to discuss later about the residential rental income. You get an amount of? Sorry, 484? 480, 400. Number two, there was other income. Patent rights, where he received a net royalty income of 95. There was royalty income. Royalty income. Also, royalty is subjected to withholding tax at the rate of 5%. You're told that patent rights, where he received a net royalty income of 95. So it's 95. This is net. We want the gross. The withholding tax is the same as 5%. This one. So therefore, divide by 0.95. But you can see that 95,000 is the same as 95%. What about 100%? So how much was the gross? 100. Then you are told that, so told that patent rights were received a net royalty income of 95. So you have the gross. Then expenses relating to patent rights were registration of patent 89. He had incurred some expenses. You see, this is what he was paid, 95. So you take it back to gross, and you take it back to gross. So that means he had done an amount of how much? 100. But to earn this, there are some expenses he had already incurred. Number one, there was registration of patent, 8,000. Will it be allowable or disallowable? That is disallowable. Why? You see, for you to register a patent, that means you had incurred before you had the patent. Are you together? So it's a preliminary expense. So therefore, it will not be allowed. It's a disallowable expense. But there was operating expenses. Now, operating expense is allowable expense. So we'll come back to discuss about allowable and disallowable. So you raise operating expenses. Now, operating expenses are allowable. What does it mean? It reduces the amount of tax liability. Right together? Yeah. So you'll claim an amount of 18. Therefore, it reduces your assessable income. You get an amount of 19. I mean 80. 88. Good. 82. So now give me the total income earned in Kenya. Total income. Total income earned in Kenya. 17,400. Good. Now give me the total income. $60. Yeah. So the total income is 62,400. The other step, now we can determine the tax liability. Tax liability on total income. So it's 10% for the first 288,000, 25% for the next 100,000, and 30% of anything in excess of 388. So you take 60, 62,400, then you deduct 388, then you subject at the rate of 30%. The total is an amount of 17. 120. Good. Then the other step, now we determine the tax liability on income earned in Kenya. Income earned in Kenya. So you take 10% for the first 288,000, 25% for the next 100,000, and 30% of anything in excess of 388. Now the total income earned in Kenya was an amount of 17,400. You deduct 388 to determine the excess amount. Then you subject it at the rate of 30%. Then you add 25,000, you add 28,800. What do you get? Sorry? 8. 567. 520. Subject to confirmation. Can other confirm? If you have a calculator, can you confirm? Woman reporter, you get, sorry? 451. 120. Good. So the difference there between the total and the one earned in Kenya will be now the tax on foreign income. How much will be the tax on the foreign income? Sorry? 13,05,000. Now you compare 13,05 against the actual tax paid in UK. He had paid an amount of equivalent to? Just read the first sentence. Paid deducted was equivalent to? 8,700, right? But that was pound. You multiply by 100 to get in Kenyan shillings, 870. So there is double tax relief, the lower off. So how much can you claim? Yeah, you only claim 870. So let's go back to the required. Number one, we are told that double tax relief, if any, due to Mr. Silvana's Jirani for the year of income 2015, get your 8 marks. Then number two, the tax payable or refundable by Mr. Jirani for the year of income of 2015. So we want to determine now the tax liability or the tax payable. It can either be tax payable or tax refundable. So first of all, determine the gross tax liability based on the total income. The total income was 6062. How much was tax on this? Good. The tax liability on the total income was 17,561. Then for the income earned in Kenya, you had already paid pay. So you deduct what you have already paid, pay. For the employment income of 950, how much was paid deducted? 184,800. Then for the income earned in UK, you need to claim a relief. So you deduct double tax relief, there are an amount of 870. Also, there is personal relief, an amount of 28,800. Also, you see, for the royalty and consultancy fee, you had received 190 net of withholding tax. There was some tax which was withheld. Yes, because in this case, you have assessed the total amount, which is 200. That means there was a tax that was withheld. So you need to claim that. So withholding tax, number one was on consultancy fee. You see, he received an amount of 190. How much was gross? So that means they had withheld how much? 10. Good. Also, there was loyalty. Loyalty, he received an amount of 95, which was net. But gross was how much? How much was the tax withheld? Now the balance is what now you'll pay. So how much is the net tax liability? 6. 5. So now that's the amount of tax payable. You can copy now. Yes. Just out of that.
There is extended relating to personal life. There is special and line. For entering some also there is
before rating.
Those are
yeah, they are they were incurred before. They'll be capitalized. Yes. But then let me make something clear. Now, this for all of you. Okay, next class we'll be doing code dwelling VAT. Now, the other class for the third week, kindly make sure you don't miss that class. Because if you miss that class, you might fraud the entire semester. That one will form the basis of the business income. Are you together? Because all the other computation, it's all about allowable, disallowable, taxable, non-taxable. So if you miss that class, you'll fraud. Yeah, but in case you miss, kindly request we give you the videos for that class. You watch. Oops. So January is asking, why are we not adding back from the employment income? Why are you not adding pay? Now we say that you only add pay when you are told that the employment income was net. Are you together? If you are told that it was net, that's when you add back pay. In case they are silent, assume it's gross. Good. So our next class will be next week, a time like this. So you only have one class for tax. Only one class. And all of you to pass. But there'll be a day I'll give you 2 classes in a week. We can cancel one for advance, then we substitute with tax, only for one. Yeah.